If you're a Forex trader, the most important currency to understand is the US dollar. It doesn't matter the hour, day, or week. There's a very good chance that the US dollar's trend is determining how your trade is moving in the majors and in the crosses. Because even with cross trades, it may be a risk-on, risk-off trade that can be partially affected by the market's demand for US dollars. In this video, I'm going to share with you 10 essential but must-know US dollar trading tips for all traders. Before I begin, you don't want to miss out on other valuable content like this, so make sure you subscribe to our channel and hit the notifications bell. Let's start by talking about what drives the US dollar. What determines its longer-term trend? As a trader, the most important thing that you need to know, and my very first tip, is that the most important drivers of the US dollar are inflation, interest rates, safe haven, and economic growth. Diving deeper into each of these gets us to tip number 2, inflation. I want you to take a look at this chart that shows two lines. The orange line is the year-over-year US inflation consumer price index. The blue line is the dollar index. Basically mirror images of each other, right? But if you look more closely, you will see the orange line actually leads the blue line, meaning that it drops before the blue line drops, and it rises before the blue line rises. What this tells us is that rising inflation is positive for the US dollar, and a sign that the US dollar could be rising and appreciating soon, whereas falling inflation is seen as negative for the US dollar, and a sign that the US dollar could lose value soon. So what does it mean when inflation is too high or too low? When inflation is too high, that means prices and price growth are too high. People start feeling that things are expensive, and they start cutting back spending. When that becomes a serious trend, it can lead to weaker consumer spending, weaker business profits, and slower economic growth. If inflation is too low, that means that prices are low. Consumers feel that things are cheaper, they have more cash, and they're more willing to spend, which encourages growth. Inflation and the level of inflation is very important to the US economy, and in turn, the US dollar. Tip number 3, interest rates, more specifically bond yields. It is one of the first things I look at when I start my trading day. I always look at whether US 10-year bond yields are up or down, because that can determine whether I'll be looking to buy or sell US dollars for our BK traders that day. And here's why. This chart shows a strong correlation between dollar Swiss and US 10-year bond yields. I mean, they're near mirror images of each other, which tells us not only do bond yields matter, but the US dollar actually tracks bond yields, and we at BK Traders use this information to trade every day. This next chart shows euro-dollar inverted, so dollar-euro versus 1-year bond yields, and you can see for yourself how closely these charts move together, which means that when yields rise, euro-dollar tends to fall, and when yields fall, euro-dollar will most likely be rising, and you should be looking for setups to buy and avoiding that setups that tell you to sell. This is a very important and practical trading tip that you can use right away. Tip number 4. Not only are interest rates important, but so are interest rate differentials, especially in currency pairs where the other currency also offers a meaningful yield, like the euro, the Australian, and Canadian dollars. Tip number 5. The US dollar is the ultimate safe haven currency, and the reason why it is the ultimate safe haven is because US bond market is the largest bond market in the world. It's irreplaceable at this stage. If investors and central banks want to park their money, there's no bigger, safer market and asset than US Treasuries. This is the single biggest reason why the US dollar will never lose its primary reserve currency status. At least, not when I'm alive. There just isn't any other bond market as large as the bond market that can absorb that flow. Also, 80% of all currency transactions involve the US dollar, so the world really needs US dollars for transactional purposes. This isn't going to change in the next few decades. Tip number 6. The most important pieces of economic data for the US dollar are the jobs report, inflation reports, retail sales, and GDP reports, and the monthly Institute of Supply Management, manufacturing and service sector surveys. Alongside the Federal Reserve interest rate decisions, these are traditionally the most potentially market-moving pieces of data for the US dollar. They have the greatest potential to drive big moves in the greenback. Tip number 7. Speaking of the Federal Reserve, they meet 8 times a year, but the most important meetings are the ones where their economic projections and dot plots, which are their individual predictions of where interest rates are headed, are released. This happens only 4 times a year, in March, June, September, and December. These meetings are the ones where we have the greatest chance of policy changes or guidance changes from the Federal Reserve, because they would have already done their homework, updated their economic projections, and they have a really good sense of how the economy is doing and where it could potentially be headed. Then, twice a year, The Federal Reserve Chairman also delivers a semi-annual testimony on the economy and monetary policy to Congress. These are also meetings where the central bank head could signal major policy changes. And they're also asked a lot of questions by Congress that could lead to some revelations. Tip number 8. The most active trading hours for the US dollar is actually US-London overlap between 6:30 a.m. New York time and 12 noon New York time. That's when we have the most participation in the US market, along with where we have the US, London, and some Asia traders on the desk. It's also when we have US economic reports released, so the chance of a breakout is the strongest during that period. Here's a classic example. My arrow in this chart is pointing at the 8 a.m. New York time, right when US data is released. Before that, we have nothing happening in dollar yen. It's just consolidating in a tight trading range. Then boom, US data comes out. In this case, it's the US jobless claims report, which is much weaker than expected. Dollar yen breaks the bottom of its range, completely melts down with a nice continuation move that lasts hours. Tip number 9. Along these lines, any big moves that happen in the US dollar pairs during the first part of the New York session that starts from 6:30 a.m. will oftentimes stop or reverse into the London close around 11 to 12 noon New York time. You can see that in the Eurodollar chart where the currency pair breaks out at 8 a.m. New York time and then peaks and reverses at 11 a.m. New York time. You can also see the same trading pattern in this dollar yen chart where it breaks down after the US data at 8:30 a.m. New York time and then bottoms right around 11 a.m. New York time. Trust me, this happens all the time. Not 100% of the time, of course nothing does, but certainly enough to make it a discernible, tradable pattern. Tip number 10. Let's talk about what it means when the US dollar is too strong or too weak. Is that good or bad? A strong US dollar is good for purchasing power for Americans. It makes travel abroad cheaper. It makes foreign goods cheaper, it reduces the cost for any businesses that rely on imported or foreign-made goods, and it also drives down inflation. On the flip side, a strong dollar makes US goods more expensive to foreigners, which could hurt exports and any businesses that sell abroad. In a high inflation environment, the Fed will allow for a stronger dollar for a longer period of time to bring inflation down. A weak dollar, on the other hand, makes Americans and American businesses feel poorer. Travel and purchases abroad become more expensive, but that also keeps spending domestic, which is what the Federal Reserve may want. The Federal Reserve tends to allow the US dollar to weaken if inflation is too low, because they want to drive up price pressures, and a weaker dollar helps that. Low inflation is not bad, but low inflation could also be reflective of a weak economy, and when inflation is too low, the Fed will be looking to lower interest rates in order to drive up inflation and encourage more spending. So we cover a lot in this video. Fundamentals are important. I use it to trade every day. If you want to learn more about using fundamentals to trade, check out my fundamentals trading course and a special discount link to my fundamental and technical trading tools in the description below. See you next time.